Hello. Today, sustainability is not only an environmental issue, it has become a major financial and investment topic. Government and industries around the world need trillions of dollars to transition towards a low carbon and sustainable economy. But the question is, where will this money come from? To find the solutions, new financial instruments have emerged, such as green bonds, sustainability linked loans, and carbon credit markets. Hello, everyone. Welcome to Clean Copper Talks. So, these mechanisms, green bonds, sustainability linked loans, and carbon credit markets, help companies and government to raise funds for sustainable projects and reduce greenhouse gas emission. In today's video, we will understand what green bonds are, what sustainability linked loans are, how carbon credit market work, the difference between voluntary and compliance carbon markets, and the digital tools and platform used to manage these systems. So stay till the last. So what is a sustainable finance? Before discussing specific instruments, it is important to understand the concept of sustainable finance. Sustainable finance refers to financial investment that considers environmental, social, and government factors, commonly known as ESG. These investment aims to support projects that contributes to climate change mitigation, renewable energy, pollution reduction, sustainable infrastructure, biodiversity protection. Financial institutions are increasingly integrating sustainability into their lending and investment decisions. This has led to the government of green finance instruments. So what are green bonds? Green bond is a type of bond issued by the governments, banks or companies to raise money specifically for environmentally beneficial projects. The concept is similar to a normal bond. Investors lend money to an issuer and the issuer promises to repay the amount with interest over time. The key difference is that funds raised through green bonds must be used only for green projects. Examples of projects funded by the green bonds include renewable energy projects such as solar and wind farms, sustainable transportation system, wastewater treatment infrastructure, energy efficient buildings, climate adaptation projects. Green bonds help channel capital into projects that contribute to environmental sustainability. To ensure transparency and credibility, green bonds usually follow the green bond principles developed by the International Capital Market Association. These principles focus on the four key components. First, use of proceeds. The money raised must be used for clearly defined green projects. Second, project evaluation and selection. The issuer must explain how projects are selected based on environmental benefits. Third, management of proceeds. Funds must be tracked to ensure they are used only for eligible green activities. Fourth, reporting. Issuers must regularly report the environmental impact of funded projects. This ensures transparency for the investors. So, what are sustainability linked loans? Unlike the green bonds, sustainability linked loans are not tied to a specific project. Instead, the loans are linked to the overall sustainability performance of the borrower. In this system, companies receive financial incentives for improving their sustainability performance. For example, a loan agreement may include sustainability targets such as reducing greenhouse gas emission, increasing renewable energy usage, reducing water consumption, improving workplace safety. If the company meets these targets, it may receive benefits such as lower interest rates, better loan conditions. If the company fails to meet these targets, the loan cost may increase. This mechanism encourages companies to continuously improve their ESG performance. Sustainability-linked loans generally follow sustainability-linked loan principles, which include five important elements. First, the selection of key performance indicators or the KPIs. These indicators measure sustainability performance. Second, sustainability performance targets. These targets define the level of improvement expected for the company. Third, loan characteristics. The financial terms of the loan depend on whether sustainability targets are achieved. Fourth, reporting. Companies must regularly report progress on sustainability target. Fifth, verification. Independent auditors must verify the reported sustainability performance. So what is carbon credit market? Another important mechanism in climate finance is the carbon credit markets. A carbon credit represents the reduction or removal of 1 metric ton of carbon dioxide or equivalent greenhouse gases. These credits are generated by projects that reduce emissions such as renewable energy projects, forest conservation, methane capture from landfills, improved agricultural practices. Companies can produce carbon credits to offset their emissions. Carbon markets help create financial incentives for emission reduction projects. So, type of carbon markets. Carbon markets are generally divided into two categories: compliance carbon markets and voluntary carbon markets. Compliant carbon markets are created by the government through regulations. Companies operating in certain sectors are required to limit their greenhouse gas emissions. If they exceed their emission limits, they must purchase carbon credits. Example: the European Union Emission Trading System, California Cap and Trade System, China's national carbon market. These markets are mandatorily and regulated by the government. Voluntary carbon market. In voluntary carbon market, companies choose to buy carbon credits voluntarily to offset their emissions. This is often part of the corporate net zero commitments or the ESG strategies. Credits in voluntary markets are generated by certified projects such as forest conservation, renewable energy installations, carbon capture projects. Organizations such as Verra and the Gold Standards certify these carbon offset projects. So how carbon trading works? The process of carbon credit trading typically involves several steps. The first step is a project developer implements a project that reduces or removes greenhouse gas emission. Second, the emission reductions are measured and verified by the independent auditors. Third, the project is registered with a carbon registry that issues carbon credit. Fourth, these credits can be bought and sold in the carbon market. Companies purchase this credit to compensate for emissions they cannot eliminate immediately. So digital platforms and software used. Managing sustainable finance instruments and carbon markets require advanced digital tools. Some important software platforms are carbon accounting platforms such as Persephone, Watershed, and Plan A help companies measure and track their carbon emissions. These platforms are important for determining how many carbon credits a company may need. ESG reporting platforms. Tools such as SAP Sustainability Control Tower, Microsoft Sustainability Manager, and Workiva help organizations manage ESG data and sustainability reporting. These tools integrate sustainability data across operations and generate regulatory reports. Carbon credit registries and marketplace. Several digital platforms facilitate carbon credit trading, such as Verra Registry, Gold Standard Registry, Climate Impact X, Air Carbon Exchange. These platforms ensure transparency and traceability of carbon credit transactions. Challenges in sustainable finance and carbon markets. Despite rapid growth, there are several challenges. First is greenwashing, where companies falsely claim environmental benefits. Second is lack of standardized methodologies for carbon credit verification. Third is price volatility in carbon markets, which can affect investment decisions. Regulators are increasingly working to improve transparency and credibility in the market. So, how does the future of sustainable finance look? The sustainable finance looks very promising. Global investments in green projects are increasing rapidly. Governments are introducing stricter climate regulations. Investors are demanding more transparent ESG data. As a result, instruments such as green bonds, sustainability linked loans, and carbon markets will play a major role in funding the global transition to a low carbon economy. To summarize this video, green bonds help raise funds for environmentally beneficial projects. Sustainability-linked loans encourage companies to improve their ESG performance. Carbon credit markets provide financial incentives for reducing greenhouse gas emissions. Together, these mechanisms form an important part of global sustainable finance ecosystem. If you found this video useful, please like the video and subscribe to the channel. On this channel, we explore topics related to environmental engineering, sustainability regulations, climate change, waste and wastewater management, ESG reporting, and sustainable finance. Thank you for watching the video. I'll see you in next video. Till then, tata, bye bye. Take care.